$1.7 trillion got erased in 90 minutes. Gold fell about $100. Silver fell about $14. And the part that should bother you isn't the drop, it's the speed. Because this wasn't a slow bleed. This was a trapdoor. One moment silver was printing a fresh all-time high around $117.75. 90 minutes later it was trading near $103. Gold slipped from roughly $5,100 toward $5,000. Same sector, same morning, completely different damage. If you're staring at that chart right now thinking, was that the top? Did the bull market just die? Stay with me to the end. I'm going to show you the two triggers that caused this move, why the crash was actually telegraphed, and the one signal that will tell you whether this was a reset or the beginning of a deeper unwind. I break down the moves most people only understand after it's too late. If this helps you, hit subscribe, because the next wave won't announce itself politely. Now let's talk about what actually happened. Around 9 a.m. Eastern, silver was on fire. Buyers were chasing it, momentum traders were celebrating, headlines were already being drafted. Gold was elevated too, hovering near record territory, looking calm and controlled. Then the floor moved. Silver dropped from about $117.75 down toward $103 in a blink. That's roughly 12%, gone, before most people finished their coffee. Gold dropped around 2%. Painful, sure, but not catastrophic. So why did silver get punched in the mouth while gold merely flinched? Because silver didn't just run into selling pressure. Silver ran into a wall that has been standing for decades. Here's the concept that changes how you read these charts forever. Markets don't move in straight lines. They move like a ball in a room. The floor is support. The ceiling is resistance. When price hits the floor, buyers catch it. When price hits the ceiling, sellers swat it. But the real danger is when a floor becomes a ceiling. That's exactly what silver hit. On the long-term chart, think decades, not days, silver has a major trend line that has defined turning points for a generation. It's the kind of level that doesn't show up on a 15-minute chart. You only see it if you zoom out until your screen feels uncomfortable. In 2008, during the financial crisis, silver collapsed and tagged that line from above. Back then, it acted like a floor. Price hit it, stabilized, and then launched. Silver was roughly $8 at that moment. And what happened next wasn't a nice rally, it was an explosion. Silver ran to about $45 by 2011, around a 462% move. That's the kind of move that turns skepticism into obsession. Now fast forward to this cycle. Silver wasn't coming down to that line, it was coming up to it, from below. Same line, different direction. That flips the physics. The old floor becomes a ceiling, and when price slams into a ceiling at full speed, it doesn't politely pause. It gets rejected, hard. That's the first trigger, the technical rejection off a multi-decade resistance level. And if that was the only thing happening, you might have gotten a sharp pullback, a messy candle, some panic, and then stabilization. But this morning had a second trigger, a mechanical trigger. The kind that doesn't care about fundamentals, doesn't care about narratives, and doesn't care about your opinion. Margins. The exchange raised margin requirements. Let me translate that into plain English because this is the part that turns a pullback into a waterfall. Futures markets run on leverage. You don't put up the full value of the metal, you put up a fraction, margin, as collateral. It's like controlling a house with a down payment. You're not buying the whole thing, you're renting exposure to it. A silver futures contract represents about 5,000 ounces. At $100, that's roughly $500,000 of metal exposure. But traders don't need $500,000 to play that game. They post a much smaller margin amount to control it. When the exchange raises margins, it's like your landlord saying, "Your deposit just doubled. Pay up today." If you're fully leveraged, you have two options: add cash immediately or liquidate. Most can't add cash, so they sell. Now imagine thousands of leveraged traders being forced to sell at the same time, not because they want to, but because they have to. That's not price discovery. That's a liquidation cascade. This week, margin requirements for silver jumped dramatically, about a 47% hike by the numbers being circulated, from roughly the low $20,000 range to the low $30,000 range per contract. Whether you think that's justified or suspicious doesn't matter in the moment. The machine does what the machine does. More margin means less leverage. Less leverage means forced selling. Forced selling means violent candles. So you had the chart hitting the ceiling, and the exchange pulling the leverage rug out from under traders at the same time. That's how you get $1.7 trillion wiped out in 90 minutes. And that's also why gold didn't get hit the same way. Gold has leverage too, yes, but it didn't smash into the same multi-decade resistance point in the same moment. And silver tends to be the more volatile metal anyway. More speculative positioning, thinner liquidity, bigger percentage swings. Silver is the sports car. Gold is the armored truck. Now here's the question that matters. Does this mean the bull market is over? Not automatically. And this is where most people get emotionally trapped. Because the worst time to make a long-term decision is during a short-term liquidation. Liquidations are not information, they are forced behavior. If you want to understand what a move means, you have to separate three things: the technical level, the mechanical trigger, and the fundamental reality underneath it. Technicals explain where the trapdoor was. Mechanics explain why it opened fast. Fundamentals explain what happens after the dust settles. So let's talk about the two paths from here: the ugly one and the explosive one. First, the bearish path. The reason this could get worse. Silver had an absurd run. In this script's world, it went from around the $30 region to over $117 in about a year. That's a parabolic move. And parabolic moves tend to end with people discovering what gravity feels like. When everyone is on the same side of a trade, it doesn't take much to tip it. One margin hike, one big seller, one technical rejection, and suddenly the crowd is fighting to exit the same door. That's how you get multi-day follow-through selling. That's how you get dead cat bounces that trap dip buyers. That's how you get the gold to silver ratio snapping back, punishing silver harder than gold. And here's the part nobody likes hearing. Once a market shows you it can drop 12% in 90 minutes, it can do it again. So yes, there is a scenario where this isn't the end, but it's not the bottom either. A consolidation, a grind, a wider correction that scares everyone out. Now the bullish path. The reason this could become a gift. Because the crash did not delete the underlying pressures that pushed silver up in the first place. In this script's narrative, the structural supply story is still there. Constrained inventories, persistent deficits, rising industrial demand, and a physical market that refuses to fully follow paper weakness. And here's the tell that matters more than the candle: physical premiums. In healthy, normal markets, paper and physical move together. When paper drops 12%, physical should become cheaper too. But in stressed markets, something weird happens. Paper gets slammed and physical barely budges, or premiums rise, because real buyers see the dip and rush the door. That divergence is not a guarantee of anything, but it's a warning sign that the market is not behaving like a simple chart. It's behaving like a supply chain. So while the paper price is falling, dealers can be saying, "Sure, but I don't have much to sell." And that tension matters because it tells you where the real scarcity is. Now let's zoom out again, because perspective is the antidote to panic. Big silver crashes don't happen in dead markets. They happen in hot markets. A crash is what a bull market looks like when it needs to cool off. Think about the pattern the last couple decades. Sharp drops, brutal shakeouts, and then, eventually, new highs. Not because it feels good, because that's how volatile bull markets transfer metal from weak hands to strong hands. And this is where the long-term chart becomes the battlefield. Silver hit that multi-decade line and got rejected. That's real. That's a ceiling. Ceilings can hold for weeks, sometimes months. But ceilings also exist to be broken. If silver eventually retests that level, builds energy, and then punches through it with conviction, today's crash becomes a footnote. It becomes the shakeout that cleared leverage so the next leg could run cleaner. This is why I'm not interested in day-to-day drama. I'm interested in the decision the market makes at the key levels. So what levels matter now? Psychologically, $100 matters. Not because it's magical, but because humans anchor to round numbers. If silver can hold above $100, stabilize, and stop bleeding, that changes the story. It says the crash was a liquidation event, not a structural collapse. But if $100 breaks cleanly and buyers don't show up, you could see a deeper search for support. That's not prophecy, that's risk management. And if you're watching this thinking, okay, but what should I do? I'm going to say something that will save you pain. Don't confuse analysis with a trade. You can be right long-term and still get destroyed short-term if you're leveraged. Leverage turns volatility into a weapon. The exchange doesn't need to beat you, it just needs to raise margins. Your broker doesn't care if you're right in 6 months. Your margin call is due today. So if you're in this market with leverage, understand what you're holding. Not just silver exposure, but margin policy exposure. Now there's another layer here that people argue about, and I'm going to address it directly because you'll see it in the comments. Was this manipulation? It could be. It could also be a textbook response to a chart level plus a margin hike. Here's the uncomfortable truth. You rarely get a smoking gun in markets. You get incentives and outcomes. The timing of margin hikes around key levels often looks suspicious because that's exactly when leverage builds the most. The exchange can claim it's risk management, and sometimes it truly is. When volatility rises, their risk rises, so they raise margins. Is it possible big players benefit from the chaos? Yes. Is it provable in real time? Usually no. But here's the part that matters. Debating motives doesn't change your account balance. Structure does. If the market is built on leverage, then leverage can be turned off. That's the rule. You don't have to like it, you just have to respect it. Now let's talk about the historic rhyme everyone keeps missing. In 1980, silver went vertical, then collapsed after rules tightened and leverage got cornered. That crash led to a long, painful period. In 2011, silver ran hard, margins got raised repeatedly in rapid succession, and the price got crushed. It felt like the end. It wasn't. It took time, it took patience, but the story continued. So which template is this one? That's the cliffhanger, because we won't know from a single candle. We'll know from what the market does after the forced selling ends. And that's why the next few sessions matter more than the crash itself. If silver stabilizes, holds key zones, and physical tightness persists, the bull case stays alive. If silver can't hold, premiums collapse, and inventory pressure eases, the bear case gets louder. So what am I watching specifically? I'm watching whether the bounce is real demand or just short covering. Real demand holds levels, short covering fades. I'm watching whether physical premiums stay elevated while paper dips. That divergence is a pressure cooker. I'm watching inventory signals and delivery stress points that show whether metal is actually available when called. And I'm watching whether margin policy tightens again. One hike can cause a flush. Multiple hikes can cause a prolonged unwind. Now I want to speak to 3 people, because right now this audience splits into 3 camps. If you sold in panic today, I'm not here to shame you. Fear is normal. But don't let a single emotional moment become your strategy. Ask yourself, did you sell because your thesis changed, or because your heart rate spiked? If you're trying to buy the dip, understand this. Dips can keep dipping. The smartest buyers don't go all in on one candle. They scale. They wait for confirmation. They refuse to let impatience dress up as conviction. And if you're on the sidelines with no position, this is the moment markets are designed to create: confusion, fear, and hesitation. The best opportunities often show up when headlines scream crash, not when everyone feels safe. So here's my question for you, and I want a real answer in the comments. Did today's move change your conviction, or did it just test your emotions? And the second question. If silver reclaims $117 and breaks that multi-decade ceiling, do you think the world is ready for what happens next? Because if it breaks, the move that follows doesn't have to be polite. It can be violent in the other direction too. And that brings us back to the number we started with. $1.7 trillion didn't vanish into space. It transferred, from leveraged hands to stronger hands, from impatient hands to patient hands, from the people who needed liquidity today to the people who can wait. That's what volatility is, a transfer mechanism. So what's the takeaway? Today's crash was not a mystery lightning bolt. It was a predictable collision between a long-term resistance level and a short-term leverage trigger. The chart told you where the ceiling was. The margin hike told you how hard the bounce would be. The only question left is what happens after the smoke clears. If silver consolidates above key levels, today becomes a reset. If it fails and cascades lower, today becomes a warning shot. Either way, don't let a 90-minute window rewrite your entire worldview. Zoom out, track the structure, respect the mechanics, and make decisions that you can live with, even if the market stays irrational longer than your emotions can stay calm. Now let's go one layer deeper, because there's a detail hidden inside that 90-minute candle. Who was forced to sell? A vertical drop doesn't always mean everyone changed their mind. Liquidation looks like a margin clerk pressing a button. As price falls, Leveraged accounts get margin calls. Those margin calls force sales. Those forced sales push price lower. Lower price triggers more margin calls. It becomes a chain reaction, and the chain doesn't care about your thesis. That's why the move was so fast. It wasn't a debate, it was a cascade. And that's why you should never judge the long-term story by the first hour after a cascade. In that hour, the price is being set by forced sellers, not willing sellers. Forced sellers dump at any price that stops the bleeding. Once the forced sellers finish, the market gets a second read. Volatility cools, price starts respecting levels again, and you can see whether buyers are actually there. So the next phase is simple. First comes the shock, then comes the bounce, then comes the test. If silver retests the lows and buyers defend them, you get a higher low, and the trend can reassert. If silver retests and breaks, you get a failure pattern that invites the next leg down. And here's the psychological warfare. After a move like this, headlines will whipsaw you. 1 hour it's, metals are dead. The next hour it's, buy the dip. The goal is to make you reactive. Reactive people overtrade. Overtraders become liquidity. Stay patient. Let the test happen. Because if the multi-decade ceiling eventually breaks, if silver regains the highs and proves it can hold above that line, then today's plunge won't be remembered as the crash. It will be remembered as the shakeout that cleared leverage right before the next repricing. One last thing. Don't watch this alone. Send it to the friend who keeps doom-scrolling the chart and making emotional clicks. And tell me below, do you think this move was a healthy purge of leverage, or the first crack in the entire metals rally? If you want the follow-up once the market gives us the test, subscribe now. I'll break it down while it's happening, not weeks later.